Well, I think it's just the process. We're at the end of the beginning rather than the beginning at the end. But just in terms of a segue, Jeff was talking about large numbers, and the House package is a pretty large number. And it comes in the context, as you mentioned, of the Moody's downgrade, like being sort of, I'd say, late to the game, third of the three credit rating agencies. There's nothing really new here in terms of the dire fiscal outlook. I think, people may just be paying more attention to it. And if you look at what House Republicans did, they're going to make a bad situation worse if you're just looking at what they're going to add to the deficit. The other thing to remember, too, is that the Senate is only going to increase that deficit dial when it goes over there. Ultimately, the House and Senate need to come together, reconcile those differences, and pass the same version. But that compromised version, again, is probably going to be worse than what you've seen the House Republicans put forward in terms of adding to the deficit.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
Welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, May 23rd, 2025. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Detta.
And I'm Steve Pavlik.
As a reminder, all the charts we reference are posted on our Twitter and LinkedIn accounts. For those investing their own assets, we encourage you to be a RenMac Access subscriber at renmacaccess.com. And for those on the institutional side of the business who aren't already clients, feel free to reach out to sales@renmac.com for more information on how we can help you navigate the market. So I guess we call this the Memorial Day weekend edition of the podcast?
Yes, definitely. Happy Memorial Day to all our veterans out there.
Absolutely. And El Jefe said, clean it up. So here I am, smooth as can be with no stubble.
Good, baby.
So
Looking good.
Still trying to get off.
Even Neil went Fu Manchu on us here, like taking it down on the sides. Hey, Neil, I was just thinking, you're absolutely right. It just takes you back to your high school days because the Knicks are choking just like they did back then.
Fuck off. I would like to point out, just for the sake of history, it should be known that when Reggie Miller famously did that choke sign to Spike Lee, the Knicks ended up going to the finals that year.
All right, fair enough.
There we go. That was the marker.
Just so we're all aware. Anyway, I'm going to the game today, so hopefully I bring them some good luck.
Boom. All right, we'll look for your courtside.
Anyway, before you get into that, can we just talk about your, ridiculous? I mean, I know Jeff is cosplaying now as a FanDuel and DraftKings strategist. How did the Knicks call work out for you last week, Jeff?
All right,
Thank you. Steve, you can go back to what you were doing before.
This is where the law of large numbers gets, absolutely. You got to think about it in terms of, expectations, value investing, etc., offsets, the edge, using the Kelly criteria.
The market wasn't bullish enough on the Knicks, I guess. Blowing out the Celtics by like 40 points?
Yeah. No, it's not been a strong showing on the NBA side for sure. For sure. All right, let's get into the nitty-gritty.
Let's go. So it's a little odd to kick off, a second week in a row around the bond market, but I think we need to start there again this week. We had a Moody's catch-up downgrade this week. I don't know what you call that, a catch down. House passed its first cut of the reconciliation package. We had a bad 20-year auction. Bonds sold off. Obviously, want Jeff to talk about the equity market implications from all that. But Steve, let's start with you. Was the House package meaningful, or is this just political posturing and it's a nothing burger?
Well, I think it's just the process. We're at the end of the beginning rather than the beginning at the end. But just in terms of a segue, Jeff was talking about large numbers, and the House package is a pretty large number. And it comes in the context, as you mentioned, of the Moody's downgrade, like being sort of, I'd say, late to the game, third of the three credit rating agencies. There's nothing really new here in terms of the dire fiscal outlook. I think, people may just be paying more attention to it. And if you look at what House Republicans did, they're going to make a bad situation worse if you're just looking at what they're going to add to the deficit. The other thing to remember, too, is that the Senate is only going to increase that deficit dial when it goes over there. Ultimately, the House and Senate need to come together, reconcile those differences, and pass the same version. But that compromised version, again, is probably going to be worse than what you've seen the House Republicans put forward in terms of adding to the deficit. Again, I don't think this is new. My guess is, again, that this is just occurring in a situation that maybe Neil can speak to about, just making another example of making a bad situation worse. Some other things that are going on in terms of the broader context. And, if you're a bond market vigilante supporter, perhaps the bond market will play a role in restraining what Republicans want to do in this compromised version. Clearly, they played a role in getting Trump to alter his tariff policy. So, I think that's going to be something to watch moving forward.
So I want to come back to you a little bit later on the sort of the political realities of the Republicans caving or, negotiating some of these priorities away to get something done. But before we hit that, Jeff, you pointed out on Wednesday to a note to clients that JGBs are at a 25-year high. And Neil, you wrote a piece yesterday that got a lot of attention in New York and with their friends in DC, that the bond market sell-off isn't about the U.S. fiscal situation, but it's happening globally.
Well, from my perspective, just for reference, JGBs are Japanese government bonds, for those not familiar with the acronym. It's a distinct difference and I think it's important because if it's easy to look at our own house and say, this is a problem and the debt to GDP and all that stuff is going to be an issue. And I wouldn't argue with that, but there are worse houses on the planet, right? And Japan is one of them in terms of the kind of the unsustainable nature of their fiscal situation. And you're seeing that, JGBs, while they're still extraordinarily low, 160 basis points, they're at 25-year highs. So a 25-year high in 10-year yields is 160 basis points. But we are, in that instance, we are seeing it have a meaningful impact on the Nikkei. If we look globally at G7 indices, stock indices, clearly the Nikkei is the laggard here and struggling. And I would say struggling in that looks like it's completing a top formation. The moving averages are sloping down. The market has rallied back up into these descending moving averages. It's struggling up at those levels as these 10-year yields move ever present and ever forward. So I think that's the one to watch as kind of the litmus test. Obviously, the U.S. has certain circumstances, reserve currency, et cetera, that are different than what we're seeing in Japan. But to me, this is really a reflection of, these things start to matter to me, and we can let Neil take this ball and run with it. But the difference here most recently is, yields have gone up in the States while the dollar has remained flat, if not contracted or gone down, right? So that's pretty unusual. If you have a growth situation, you can get yields to go up, but usually that stronger economic growth is reflected also in the dollar. If you have an inflation situation, you can get yields to go up and the dollar to go down because of the purchasing power deterioration. That's not really reflected in real yields at this point and inflation expectations. So I don't think it's that. There's other things happening. So this has been and remains kind of the top issue for problems that we could have with the U.S. equity markets. I still think this is probably more sentiment driven than anything else. I mean, what I just would remind people is that capital flows to where it's treated best. End of story. That's just the way it works. You can have some sentiment. You can have some geopolitical policy uncertainty that creates these little near-term tremors. But the reality is capital will flow where it's treated best. And I think that's something that people need to keep in mind just structurally as you think about what's happening globally.
Neil, you got any thoughts on that?
No, I mean, look, people are rotating out of bonds. They're not rotating out of only US bonds. And I think that's important. The curve is steepening everywhere, not just in the United States. So that would suggest that there's a global element to all this. And you can see that sort of in the market behavior, like intraday, right? Like, so what got the 10-year yield going a couple days ago was a very weak 20-year bond auction. Then you had a weak, sort of a strong inflation report out of the UK. And then you had a 20-year auction in the US that went poorly. So about half the increase, in that one trading day was driven by overseas developments. And keep in mind that the 20-year is like a very unusual kind of product, fixed income product. There might be also something else going on. I mean, remember, investors have been betting on a US recession for years, right? And that hasn't materialized. So maybe people are just getting tired of betting on it. That could be something else that's going on. But I would just point out that, nominal growth is running below 10-year yields in many countries. And the US looks good by comparison. So when you look at, Japan, France, Germany, Italy, their interest rates are actually running above the level of their nominal growth. Is there major fiscal legislation going through the Japanese Diet, or the Bundestag, or, so it's just, I think a lot of this is just, frankly, trying to fit a narrative to data, not actually looking at it and doing, real analysis. And I also think people are kind of making inconsistent assumptions about how forward-looking the market is. I mean, breaking news, everybody, a unified Republican government wants to pass President Trump's signature tax and spending legislation from his first term. Shocking, right? I mean, I think the other thing, of course, is that this notion that rates are a discipline mechanism. I mean, that is so just no. I mean, if anything, the causality works the other way, right? Like the people in the I don't know what it is in DC, but maybe it's the water. I have no idea. But look, I mean, in the 2010s, they were doing austerity with interest rates basically pinned to the ground. Now they want to do, extensions of these laws, even with rates somewhat elevated. So, the other thing I would point out, last point, is just the net fiscal stimulus of all this is actually quite small. Like, all the numbers that are being thrown out there, like, yeah, it's a huge increase in the deficit against some fake baseline no one believed, right? Did anyone really think that they weren't going to have some extension, right? Like, so when you talk about like you're adding this much to the deficit, no, you're adding a big increase. Like, you're assuming that the law goes away and then you pass it, therefore it goes, like, it's going up. I don't think anyone in the market really thought that it was credible. So the net, like in terms of like how much the deficit is going to change relative to GDP next year versus this year, that number is going to end up being quite small, which means the net effect on growth is going to be quite modest, maybe negligible, frankly. So anyway.
The thing to keep in mind is that, your point, which is this a repudiation of government debt, right? Instead of just US debt. And I would totally agree with that. That's what's happening. And you're seeing it look, Bitcoin made a new high this week, right? I mean, so people are finding alternatives. Gold's been in an uptrend for, I don't know, a year and a half now, at least. So definitely there is some thought process out there that, people are more comfortable in alternative assets. It's not just a U.S. debt situation, but it's a global debt situation, and particularly a global bond, a global government bond situation.
Well, I could just point out on the Bitcoin aspect too, you had some very positive policy development in terms of a bill actually moving through the Senate with enough Democrat support to suggest it will be there. And I think we were talking about a more favorable regulatory environment by providing clarity. I think that's also something that was probably positive for Bitcoin and other areas in that space. I guess one question I had for Neil, when you talk about what the Republicans want to do, and largely of a continuation of existing policy, we're hearing different growth estimates. I think the Tax Foundation is suggesting maybe a 0.5% growth to GDP. White House suggesting, if they get closer to 3%, that'll pay for itself. I mean, where do you fall on that?
Stop. I mean, come on.
Is that a 0%?
Things like that. This is not. No tax on tips, no tax on overtime. I mean, you're talking about a relatively small number of muted number of workers, relative to the overall workforce that will benefit from those policy changes. That's the only, that's not going to really move the dial, I don't think, on growth. Some of the stuff that is more growth friendly, they're making temporary, like, business expensing. Right. I mean, that's basically a 4-year window. So I think, tax cuts, when they're made permanent, have more of an effect on behavior. The most growth friendly aspects of the legislation are the ones that are going to be temporary in nature. So I don't really see much of a growth impulse from this. And, I don't know what else to say. I don't think I'm alone in that regard. I mean, it's I was thinking I don't think that this is going to happen, but I was thinking as a thought experiment, like, what if they just let the whole thing just expire? How much would interest rates go down? And what would that mean for growth? Interesting thought experiment. Not that it'll happen, but, I think that, to me, it's I would prefer a situation where they just lock in the corporate tax rate and let everything else just go back to where it was in 2016.
I'm going back to my flat tax idea. Flat tax.
Flat tax.
Don't worry about it.
But to answer your question, like, the growth effect of this is actually quite small, because the universe of workers that these things apply to, just think, let's use common sense. Like, there's a reason why both of you, not just Trump, but Kamala too. Like, there's a reason why they were basically doing this in Las Vegas, because that's really where this is going to play, so that's, that's one place out of the entire country. So the universe of people this applies to is actually quite small. So therefore, the effect on growth is going to be quite small.
Jeff, I want to switch gears, or at least go back to something I think we highlighted in the beginning about this downgrade from Moody's. But in your weekly survival guide on Tuesday that you send out to clients, you laid out historical performance of markets around sovereign debt downgrades. Not a big deal for markets, or is it?
No, if you look, it's not. I mean, and we've had several of them, right, throughout the history of the world. When we look, and let me just get the data, the punchline for us is there really isn't anything to see here. And I think there's two ways to think about it, right? This was a Moody's downgrade. The first downgrade was from S&P, and that was on August the 5th, 2011. So we're talking about 13 and a half years ago. That's the shocker, right? That's the big one. You go from AAA to AA plus. So that's kind of the first one. This is pile on. This is Jefferies coming out after Bank of America, Citigroup, Goldman, Morgan Stanley have already downgraded a stock, right? I mean, come on, it's like, who cares? So I think you have to think about it that way. But you had Japan was downgraded. Their first downgrade, let me see this here. First downgrade was September 11th of 2001, right? So the market didn't do that well for Japan, but the bond market did fine, right? If you look at France, the downgrade was in 2012, the January of 2012. UK downgrade was the first one from S&P was 2016. Moody's had downgraded them in 2013. Canada was downgraded. Italy was downgraded. And, it just doesn't, the punchline is on a relative basis, 6 months after, the markets are about 70 basis points ahead of what they usually are for 6 months out. So I think it's nothing to see. I don't want to conflate that to, I don't care and it's not important. I do think it's important. I think, having your fiscal house in order is important, particularly when it's peacetime, particularly when, you don't have crises. I mean, that's why it's important, because then when you have COVID, when you have, God forbid, a conflict, you've got the health to be able to sustain it. The idea that we can just spend and spend when things are good. I mean, this is Keynes rolling over, right? Keynes was all about let's run these surpluses in good times and then deficits in bad times, and that'll work. But of course, politicians take it to the nth degree, and they screw that decent thought. I think it's a decent thought. I don't think it's a great thought. They screw that thought up pretty convincingly.
Thanks. Neil, you were speaking this past week at the John Burns Real Estate Conference. You've been a bear on the housing market as a driver for the economy. If you just take the old Econ 101 formula, C plus I plus G plus net exports, you're not getting a ton of lift from the housing sector. Is that right?
No, that's right. That's been the case for a while now. I think the main story going on in housing is, none of it is actually good for home builders, and that's what ultimately matters for the market. You look at the resale market, which doesn't get as much of attention, but inventories are climbing and prices are coming down. So one of the reasons why builders had been doing so well, even in a rising rate environment, is because they were the only game in town. That's not as much the case anymore because inventories are climbing basically back to where they were right before the pandemic in the resale market. So builders have more competition now. And at the same time, at the end of the day, going back to our earlier discussion, rates are rising essentially for reasons unrelated to growth and inflation dynamics in the U.S. It's not, the curve is steepened. It's not like you've seen much movement in market expectations for the Fed. There's a global element to this, which means risk premiums have gone up. That is keeping mortgage rates elevated. So you have higher mortgage rates even as the labor markets are still cooling down. So the math is actually becoming more challenging. And if you're a builder trying to move product, this basically means that you're going to have to take more of a margin hit to get that product out the door. Maybe you have to increase the more favorable financing terms for people, buy them down even more. Maybe you have to cut prices. So that's not good for home builders. It's not good for construction. I think that the interesting wrinkle in this now is employment, okay? Because you're getting now to a point where it doesn't really make as much sense to hold on to all these construction workers. One of the big differences now between the last time residential investment contracted back in 2022 was that units under construction were falling, were rising then, and they're falling now. We'll see what happens. I just think it's the housing market simply does not work with interest rates this high. It's just that simple.
And Jeff, we get this question a lot. Obviously, there's this tug between economic data and market data and the delay there. So what are the markets telling you that maybe are different than what Neil's forecasting in terms of the economy?
Well, I think with housing, it's spot on, and it's been that way for probably 9-10 months now. Housing seemed to peak, at least the housing stocks and kind of building related peak back in the summer of last year, along with semiconductors, by the way. The economic outlook, that's Neil's call. We do the market stuff, right? I guess the one thing I would look at that would be more encouraging from my seat in terms of the economic call really lines up in terms of what's happening in banks, what's happening in financials, which still look decent. That's unlikely to happen if you're going, into a recession, particularly something that's prolonged. You're going to have banks do well because of the curve, though that has come under some pressure, since the great financial crisis. Frankly, that relationship's not as strong, but generally that's better. The steeper curve is better for financial institutions. But at some point you cross the Rubicon where that steepness actually ends up becoming not a tailwind anymore, but the deterioration that you get from credit quality, delinquencies, and loan growth actually ends up dominating, right? So that's why it's important to watch financials. And frankly, financial relative performance has been good, remains strong and vibrant, and still looks good. And I think importantly around that is it is global in nature. It is not just in the U.S., it's not just in Europe, but it's in China, it's in the U.S., it's in Europe. So I think that's an important underpinning to all this. The other are corporate spreads, the triple B versus double B spreads, spreads to treasuries, however you want to really measure it, just still shows that there's not a lot of stress in the system in terms of pricing of credit, right? So if you're going to hit aggregate demand in a substantial way and in a broad way, obviously the ability to get paid back goes down. And so the pricing of credit starts to widen. And we're not seeing that. So I think there's going to be pockets, and we're seeing some of those pockets certainly get hit. But I'm more encouraged that we're not seeing the kind of typical signposts that start to make our palms sweat in terms of what that implies for equities.
All right, thank you. Well, it's mailbag time. I would remind listeners that if we use your question, you'll get a nice RenMac trucker hat, lots of styles and colors. You can tell us what you want, and we'll get it to you.
What makes it a trucker hat, by the way? What's the difference between a regular hat and a trucker hat?
It's the mesh in the back, apparently. And this week, by the way, you're going to get this nice Memorial Day edition of the RenMac trucker hat. So
that's an early one.
I think this might be the OG. This was the original one. Eric Boucher was in charge of this and got a really good looking one. So you'll get that. You can wear it around 4th of July too. It's fantastic. Let's bring in Harry Chen. Harry, for the mailbag question this week. Good morning, Harry.
Okay, today we have the question from Taylor Hart. Question is, given your view that economy is jumping into a recession, what specific indicators or data points are most concerning to you right now? Thank you.
All right. So given, Neil, I think this one's to you, given your view that the economy is quote unquote jumping into recession, what specific indicators or data points are most concerning to you right now, and how do they differ from previous recessionary periods? What say you, Neil Dutta?
Well, to me, I mean, this is sort of shouldn't be surprising, but I do think that employment is important to keep an eye on, specifically continuing claims, because the nature of this slowdown is very different than what we typically see in recession, right? Where you basically see a huge increase in initial claims and we sort of know the game is over at that point. What we're seeing so far is basically more of a slow boil and, then maybe a roll, but continuing claims keep going up, and that's probably going to continue for the foreseeable future. If you look at continuing claims, they're rising about 5 to 6% a year. And I think that probably means we'll be, close to 2 million at some point over the next few weeks. And what that is a reminder is that a lot of the weakness in the labor market is a function of low rates of job finding. And so even though layoffs remain low in level terms, those newly laid off people can't find work. And as a result, unemployment keeps going up. At some point, that will slow things down because you exhaust your savings buffers and jobless claims. And, to the extent that the Fed is still waiting around and doing nothing during this process, that represents a passive tightening of policy. The other thing I would say is, even though layoffs are low, they actually have been going up a little bit at the margin. I mean, when you take a look at some of the data from the current population survey, you can see that layoffs have been climbing. We see that also anecdotally. I mean, you have corporate restructuring going on. If sort of everyone's restructuring at the same time, that becomes a macro issue. I mean, we learned this week, for example, that Walmart's laying off a lot of people in their corporate offices. That's important because the hiring rate is really low, right? So at the margin, I guess, a modest increase in layoffs will have an outsized impact on employment. So I just don't think it would take a lot to kind of shift the narrative around the balance of risks in the economy. We kind of came off the ledge with tariffs, and everyone's kind of thrown in the towel on the recession call. But to me, I think it's way too premature to do that.
Hey, I got a question for you. Actually, this is a question from a listener, Bo Damon. So maybe it's two hats today, but it's a good question. I think it's worth peeling back the onion on. So his question is, folks getting laid off from high quality jobs, where are they going? Is it part-time? Is this borne out in the numbers, et cetera? So just kind of in addition to that, where are high quality job layoffs? Where are people going from there?
I mean, they're probably going to unemployment claims, I would guess, because there aren't many high opening job openings. I mean, job openings have generally been coming down when you look at sort of high frequency measures of job openings. So, it's a very sort of, lack of inertia kind of job market. So I don't really think the opportunities are actually becoming going down, not going up. So this is a very, very bad time to lose a job generally, and that's true of white collar workers as well. It's okay if you have a job right now, but if you just lost one, it's not really the best situation.
Refreshing.
All right, let's do the around the horn sort of week ahead. Steve, let's start with you, but maybe your horizon's a little bit longer than a week. I know Congress is in recess this week, and we really want to focus in on that reconciliation package. I know you touched on it a little bit, but how do the Republicans or Congress in general get over the hump here, concessions they may or may not have to make to get the W?
Well, Republicans are negotiating with themselves. And so, I think in the end of the day, in order to pass the compromise version, as the name suggests, you're going to have to make some compromises. I think fiscal conservatives are going to add more to the deficit than they want, not achieve as much savings as they were hoping for. Should point out too, for all the hype around the Department of Government Efficiency, right now, according to their website, they've achieved $170 billion worth of savings. Now that's far lower than the $1 trillion that Elon Musk had set for the initial goal to be announced by the end of May. So I think that's really important moving forward. I really don't see spending changing nearly that much. In terms of where things are going to shake out, I think it's going to be interesting in the Senate, because you don't have any senators there that represent SALT states. So, I think in the end, you are going to be restrained by these small congressional majorities in both the House and the Senate. It's really going to be incumbent on President Trump to crack some heads and get them to eventually pass this. At the end of the day, I think it's too big to fail, in the sense that the cost of not doing anything are just too great, which is why I'm optimistic they do something before the end of August. The thing to watch when lawmakers return the week after next is going to be how much consideration is the Senate giving to the House, in the sense that, are they sort of pre-conferencing? Are they making changes with House input in mind as to where they think the compromise product will end up? If they do that earlier in the process, that's probably better for the timeline and reaching the goal ahead of, again, the August recess. Outside of this, if you're asking me what I'm watching next week, I think it's going to be, we're recording this Friday at May 23rd. We always have to do sort of a timestamp when it comes to tariffs. President Trump is threatening a 50% tariff on imports from the European Union, set to take effect next Sunday, June 1st. I think Sunday is an interesting time, in the sense that you could actually go into the tariffs because it really wouldn't take effect until Monday. So maybe sort of you need that to try to get some last minute negotiating there. We saw Trump again in April 9th to be exact, follow through with his reciprocal tariffs for a few hours before taking them back. I think there's frustration on the Trump administration from the fact that, a lot of these large trading blocs, particularly those that are auto exporters, just don't have much incentive to come to the table right now. Trump is being insistent on the sectoral tariffs, that's 25% on imports of autos, and also this maintaining of the 10% universal baseline tariff. So, if you're basically drawing a line in the sand saying, we're not going to negotiate these things, then a lot of these trading blocs are saying, well, then what are we going to negotiate? What do we have in order to save face? And so I think that frustration may be spilling over into public. And look, however the European Union handles this, my guess is that Japan and Korea are going to be watching intently too, because they also are large auto exporters. So that's sort of how I'm thinking about next week and beyond.
Neil, your thoughts? In addition, I guess Fed Chair Powell's got a little longer. He's not going to be on the unemployment line pretty soon, or anytime soon, with the Supreme Court at its back, right?
Well, yeah, that's reassuring. I do find some of the Fed speak interesting of late. Governor Waller was on Fox Business earlier this week, sort of laying out a path to rate cuts later this year. Sort of interesting to think about a potential dark horse candidate for Fed chair. I do think that that would represent continuity in terms of the markets, because Waller is the current governor, and he was nominated by Trump last time, in addition to Mickey Baumann. But if he's right about inflation, frankly, he should be rewarded with that seat. And I think the economy evolves in unexpected ways sometimes, and that constrains sometimes political decisions. So if Trump was thinking that he would be able to put someone through that's more politically pliant, but the economy is in a much weaker or precarious position, 5 or 6 months from now, then maybe he decides not to do that. So it's just something to think about. We'll be talking about it more, I'm sure, in the months ahead. In terms of the week ahead, there's a lot going on, even though it's a holiday shortened week. We'll be getting data on home prices from Case-Shiller, consumer confidence from the Conference Board. We'll be keeping a particularly close eye on that because it's very useful in terms of, informing us about labor market conditions. We'll get the core PCE inflation number. And remember, April is going to be another good month for core PCE. I mean, based on what we know about CPI and PPI, we're looking for just 0.1 on core PCE. And we also get, advanced data on trade, which you can imagine will be all sort of screwed up given, tariff threats make people pull forward spending. If people think tariffs are going to go back down, they may delay spending. So it kind of has a lot of, shifting and jockeying in the data.
Jeff, what's on your radar this week?
Well, I think we're going to continue to watch for this shift away from beta, not in wholesale. I don't want to make it sound like we're bearish on beta because we're not bearish on beta. But at this point, you tend to see relative performance really start to kick in and sow the seeds of what the next narratives are going to be. So I think it's important to watch those relative strength breakouts. We've got those lists for clients, obviously. We keep publishing those and looking for where the market is really guiding us into the next bull phase, and what's going to work. And the reason that's important, even if we're wrong, God forbid, but if we're wrong, and we have more of a decline than we think that we're staring down the barrel at here, those should still hold up, right? Those will be relative strength leaders even in that decline. So beta, that will not happen. If it's just beta will go down. If it's relative performance and momentum, those will actually hold a little firmer. So clearly watching that. We'll continue to watch the bond market, but I think for us, the bond market, our yield impact model is not at a point where it's saying, danger, Will Robinson, we've got a problem here. But we are very close to breaking out on a few of these levels. The issue there will then be, okay, now that we've done this, what do we need to watch for to suggest that it is going to start to impact equities? And that's what we're going to watch for. We talked a little bit about banks, et cetera, but we'll make sure we're keeping an eye on that for our clients as we go.
Thanks, guys. Just as a reminder for our clients out there is no Monday morning macro call. We'll be off on Monday for the holiday. We'll be back for that call the next Monday. But we'll be back here for this podcast next week when we'll be 1 week older and 1 week wiser. And as always, don't forget to follow us on Twitter, YouTube, and anywhere else that you can subscribe to get our latest thoughts. Until then, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Powell.
Have a great week, everybody.